Imagine waking up on a Monday morning. No alarms, no stressful commute, and best of all, no boss breathing down your neck. Instead, you sip your coffee knowing your bank account is growing while you sleep. Sounds like a dream, doesn't it? But here's the thing, it doesn't have to stay a dream. Today we're talking about building passive income through dividend stocks, ETFs, and REITs, your golden ticket to financial freedom and even early retirement. Before we dive in, hit that subscribe button and give this video a thumbs up because you don't want to miss the tips I'm about to share. Stick with me till the end, and I'll walk you through a simple, actionable way to start building your passive income today. Chapter 1. Why passive income is the key to early retirement. Let's talk about why passive income is a game changer. Relying on a job means you're trading your time for money. But what if your money could work for you instead? That's the magic of passive income. It's money that keeps flowing in whether you're working, traveling, or spending quality time with loved ones. And here's the exciting part. Early retirement becomes possible when your passive income is enough to cover your expenses. No more waiting till you're 65. Instead, you could retire at 40 or even earlier. If you didn't have to work for money, how would you spend your time? Travel? Pursue hobbies? Start a passion project? Let me know in the comments below. And one of the most reliable ways to create passive income? Investing in dividend-paying stocks, ETFs, and REITs. Let me show you how to pick the right ones. Chapter 2. What are dividend stocks, ETFs, and REITs? Before we dive deeper, let's make sure we're all on the same page. Here's a quick breakdown. Dividend stocks. These are shares of companies that regularly pay a portion of their profits to shareholders. It's like getting a thank you check just for being invested. Dividend ETFs. Think of these as baskets of dividend-paying stocks, offering diversification in one investment. Real estate investment trusts, or REITs. These are companies that own or finance income-producing real estate. They're legally required to pay most of their profits as dividends, which means higher payouts for you. Each of these is a powerful tool for building steady, reliable passive income. Chapter 3. How to select dividend stocks. Let's start with dividend stocks. How do you pick the right ones? It's not just about the yield. It's about choosing companies with strong management, solid fundamentals, and healthy cash flow. Let's break it down. 1. A stable dividend yield. A yield between 3% and 6% is often sustainable. While sky-high yields may look tempting, they can sometimes signal underlying financial trouble. A stable yield shows the company can consistently reward shareholders without overstretching its finances. 2. Payout ratio. This is the percentage of earnings paid out as dividends. A payout ratio under 60% indicates the company is not only rewarding its shareholders, but also reinvesting in growth. This balance shows strong, forward-thinking management. 3. Track record of consistent payouts. Look for companies that have been paying and even increasing dividends consistently over the years. This isn't just a sign of financial health. It's proof of the company's commitment to its investors, even during tough economic times. 4. Strong management and fundamentals. A company is only as good as the team running it. Look for firms with experienced leadership, clear strategies, and solid competitive advantages. This ensures they can weather economic storms and keep delivering. 5. Healthy cash flow. Dividends are paid from cash flow, not just profits. Strong cash flow means the company generates enough money to cover its expenses, invest in growth, and pay dividends. A reliable cash flow ensures the company can sustain payouts even in challenging times. Would you feel more confident investing in a blue-chip company offering a steady 4% yield with a proven track record? Or would you take a chance on a smaller company offering an 8% yield but with less stability? Let's hear your thoughts in the comments. Remember, Choosing the right dividend stocks isn't about chasing the highest yield. It's about finding companies with strong foundations that will grow and pay you consistently for years to come. Chapter 4. How to choose dividend ETFs. If the thought of picking individual stocks feels overwhelming, don't worry. Dividend ETFs are here to save the day. They offer built-in diversification, making it easier for you to build a steady income stream with less hassle. Here's how to choose the right one. 1. Expense ratio. The lower the expense ratio, the better. This is the fee the fund charges to manage your money, and lower fees mean more of your hard-earned cash stays invested and working for you over the long term. 2. Sector focus. Consider ETFs that invest in stable, recession-resistant sectors like healthcare, utilities, and consumer goods. These industries tend to perform well even in uncertain economic times, providing a reliable source of dividends. 3. Yield and dividend growth. Don't just look at the current yield, check the fund's history of dividend growth. Consistently growing payouts indicate that the companies in the ETF are financially strong and committed to rewarding shareholders. 4. Liquidity. High liquidity is key. Look for ETFs with high trading volumes, which makes it easy to buy or sell when you need to. Liquidity ensures flexibility and avoids large price gaps when trading. 5. Fund size and reputation. Larger ETFs with a long history and good reputation are generally safer. These funds are managed by experienced teams and often include well-established companies, reducing the risk of underperformance. Would you prioritize a lower expense ratio or higher yield when choosing a dividend ETF? Drop your thoughts in the comments. I'd love to hear your strategy. Dividend ETFs are a fantastic way to invest passively while enjoying consistent income and diversification. Keep these tips in mind, and you'll be on your way to building a rock-solid portfolio. Chapter 5. How to pick REITs. Let's talk about REITs, one of the best ways to earn steady, reliable passive income in both Singapore and the US. They're popular for their higher yields and predictable payouts, but choosing the right REIT requires a closer look. Here's what you need to know. 1. REIT type. Ask yourself, what sector aligns with your goals? Here are the main types of REITs to consider. Residential REITs focus on housing, which tends to stay stable even during economic uncertainty. Retail REITs depend on consumer spending and can thrive in growing economies with strong retail demand. Commercial REITs specialize in office spaces, which are often secured by long-term leases, providing steady cash flow. Healthcare REITs benefit from aging populations and the consistent demand for medical facilities, making them recession-resistant. Industrial REITs focus on warehouses, logistics centers, and manufacturing facilities, sectors booming with the rise of e-commerce and global supply chains. Each sector shines in different economic conditions. Choose one that aligns with your strategy and market outlook. 2. Occupancy rates. High occupancy rates are a must. They ensure the properties are generating consistent rental income. Whether it's a residential REIT with apartments fully leased or an industrial REIT with warehouses in high demand, occupancy is the backbone of your dividends. 3. Debt levels. Evaluate the REIT's debt-to-equity ratio. A well-managed REIT maintains healthy debt levels, ensuring financial stability even during downturns. Over-leveraged REITs can face challenges in paying dividends, so stick to those with balanced debt management. 4. Geographic exposure. Consider where the REIT operates. Singapore-based REITs often focus on high-quality local assets, like malls, offices, and industrial spaces, offering exposure to a stable economy. U.S. REITs frequently have properties spread across multiple states or even internationally, providing broader diversification. Geographic diversity can reduce risks associated with a single market, So pay attention to the REITs portfolio. 5. Dividend payout history. Look for REITs with a consistent or growing dividend payout record. This demonstrates financial strength and a commitment to rewarding shareholders, even during challenging economic periods. Which type of REIT do you think is most appealing? Residential, retail, healthcare, commercial, or industrial? And why? Drop your answer in the comments. I'd love to hear your perspective. REITs are a fantastic way to build passive income while diversifying your portfolio. Whether you prefer the stability of residential REITs, the growth potential of industrial REITs, or the resilience of healthcare REITs, there's something for everyone. Take the time to research, and remember, your future self will thank you. Chapter 6. The Power of Long-Term Investing. Here's the ultimate secret to building serious wealth time. Dividend stocks, ETFs, and REITs aren't flashy get-rich-quick schemes. They're wealth-building machines when you play the long game. The key lies in two powerful concepts: compounding growth and the dollar-cost averaging (DCA) strategy. Compounding growth happens when your dividends are reinvested, allowing your money to grow exponentially over time. Think of it like planting a small tree that eventually becomes a forest, producing more fruit, or dividends, every season. Dollar-cost averaging (DCA) is a strategy where you invest a fixed amount regularly, regardless of market conditions. This not only takes the guesswork out of investing, but also helps you buy more shares when prices are low and fewer when prices are high, averaging out your cost and reducing risk. By combining compounding and DCA, even modest investments can grow into substantial income streams over the years. The earlier you start, the more time you give these forces to work their magic. You don't have to start big, just start. Even a small monthly contribution can grow into something extraordinary with enough time and consistency. The important thing is to begin today, not tomorrow. Your future self will look back and say, "I'm so glad I started when I did." So why not take that first step now? Conclusion. So, are you ready to take control of your financial future? Remember, every big journey starts with a single step. Start researching dividend-paying investments today and take that first step toward building your passive income. The best time to start was yesterday, but the second best time? Right now. Don't wait for the perfect moment. It doesn't exist. The sooner you begin, the more time you give your investments to grow and work for you. If this video inspired you, smash that like button and subscribe to Wealth for You, your go-to channel for everything you need to know about building passive income, achieving financial freedom, and living life on your own terms. What's your passive income goal? Is it $1,000 a month? $5,000? Or even more? Let's dream big together. Drop your goals in the comments below. I'd love to hear what financial freedom looks like to you. Until next time, keep investing in your dreams, and remember, you've got this. Stay consistent, stay focused, and watch your future transform. See you soon.